Attendees are in listen-only mode.
Welcome everyone. This is Mark Campbell, the Executive Director of CDIAC. I want to welcome you to our webinar, Intermediate on Math, Part 1. Since this is Part 1, we're expecting to have a Part 2, and I'll announce that now. August 20th, same time period, 2 to 3:30, we will do Part 2 of this webinar. We've got the presentation slides available on the CDIAC website. Your screen should display the URL for that. So if you're needing those, you may connect through that link. Captioning is provided during the program. Participants may click on the link in the chat section at the bottom of the control panel to access remote captioning. To submit questions throughout the webinar, and I do expect there will be some, please send us your comments or questions in the box marked questions near the bottom of the control panel. And finally, for a certificate of attendance, you must be registered and logged into the webinar under your own name. A certificate will be emailed to all participants at the end of the week. If you require MCLE credits, please email cdiac_education@treasurer.ca.gov. All right, I'm going to take a minute here to run through some polling questions which will help our speaker, Louis Choi, prepare or modify any of the content here. So let's roll those. I'm going to read them off. The first question is, how do you describe your knowledge or experience in regard to the debt financing? Are you a beginner, intermediate, or advanced? I'll give you a minute here to respond to that. All right, looks like we've got a fair number of intermediate, and as billed, this is an intermediate course. All right, we'll go to the next one. Are you directly responsible for debt issuance and administration or oversight in your agency? Take another minute here. Looks like we've got a near even split in responsibilities, so at least half of the participants today are directly involved in the debt issuance or administration. All right, let's go to number 3 here. If you are with a public agency, if you'll take a minute to describe your role, select from the following: debt management and administration, treasury management investment officer, budget officer, other finance related, and none of the above. Please select all that apply to you. I think we've got the capacity to record that. Okay, so we've got a fair number that are involved in debt management as well as the treasury management and then other finance related responsibilities. And our last polling question, do you plan to participate in the Intermediate Bond Math Part 2 webinar, which, as I announced, will be August 20th? Okay, great. Louis, that sets you up for the expectation that we'll have people that will participate in our second program. Our speaker, Louis Choi, is Senior Managing Director with Prague. He joined the firm in January 2005 and serves as the primary investment advisor for the Prague's Los Angeles office. He has quantitative analytic experience, includes forward-starting swap pricing models, tracking historic performance of municipal variable rate securities versus various swap indices, and structuring refundings with derivative products. Prior to joining Prague, Mr. Choi was an investment banker in the public finance departments of 2 national investment banking firms. He has structured over $4 billion in transactions, including both new money and refunding, tax-exempt and taxable, fixed and variable rate, and traditional and synthetic structures. So with that, Louis, I'm going to turn it over to you and let you take off.
Thank you very much, Mark. Good afternoon, everyone. Hopefully everybody can hear me fairly well. This is the CDIAC's Intermediate Bond Math Part 1 course. It is billed as the Bond Cash Flows Literacy. But we're really going to do a little bit more than just literacy here. The topics that we're going to cover today include looking at how bonds are really a proxy between loans, how municipal bonds are priced or valued, and understanding the cash flow schedules that people often get, how to do some debt amortization, and then as an added bonus, we're going to cover how to use some Microsoft Excel functions that are related to the above topics. We're going to expect that people will have a variety of questions, and hopefully at the end of each section or after several pages, as the case may be, for longer sections, we're going to pause and try to answer some of those questions so that everybody can try to follow along as best they can. And what you'll notice at the end of this presentation is that we're not going to cover all topics related to all aspects of these topics, as some of the material is quite in-depth, and that's why we've split this training session over 2 separate webinars. Without further ado, the first thing we're going to really talk about is how bonds work in the context as being a proxy for loan. Bonds serve the dual purpose of being both an investment and a loan, depending on which side of the issue one is on. For the investors, it's an investment opportunity, and for that, there's a certain time for repayment and a rate of return that's commensurate with the risk and opportunity costs for the funds that they invest in. And that's sort of what you see graphed here on the top part of the page. And then that's one aspect of being a bond. That's a singular bond or a group of bonds within a maturity. And that's how it would look like in terms of cash flows for that bond. But it also serves from an issuer perspective the role of a loan when bonds are aggregated together, where there's a repayment of interest and principal that are structured to be reasonably affordable over time. For most of the issuers' perspective who are originating municipal bonds, that is the kind of cash flows and the kind of use that they'll have. But it is important to understand that it is an investment vehicle on the other side, because at the end of the day, that's going to help you understand why, or give an appreciation or perspective on why things work the way they do, and why some of the complexities of the math related to bonds exist. These 2 graphs obviously look very different, with the investment portion of it being basically a reverse L shape, and the loan portion of it being a square box. But really, one can really transition between those 2 things by, as I said, aggregating multiple series of bonds. And in the next slide here, we've sort of depicted how one goes about doing that. And here what you'll see is that originally starting with a single bond of a single maturity that pays both principal in red and interest in gray, as you stack on additional bonds, the top right graph, and progressively add to that L, over time, the aggregate structure will be such that it very much mimics the loan repayment of principal and interest that one is familiar with things like mortgages, car loans, and things of that sort that one sees more commonly at a consumer finance level. And mathematically, the loan and bond issue aspect, it reflects all of that as well. One of the things that bonds being an aggregation of multiple different separate securities really expands upon is the ability to have multiple interest rates. And we're trying to show, we tried to show some of the math here that will lead into the rest of the presentation as we take a very much of a deep look at the cash flows and things that go into structuring bond financings. And then the top part of it, I think it's fairly familiar with folks in the sense that, you know, you have a loan, you have a principal pay balance that gets paid over time, and distributed across multiple periods, and along the way you're also paying interest on that loan. The amount of interest over time goes down as the outstanding principal balance declines, but overall, most of the time, people structure their debt service payments to be roughly level over time, and then that's what you see in a typical loan. And there's a single interest rate that reads off of all. That's applicable to all of the different principal amounts. Whereas for a bond issue, one of the complexities is that there are multiple interest rates involved, and that each bond, while it's outstanding, will bear interest at that respective rate, and that the total interest amount that an issuer pays is the summation of all of those individual pieces of interest added together, and the total amount that they pay in terms of debt service on the right-hand side is really the summation of the interest amount as well as the principal that is being amortized. And that mathematically, the bond issue and the loan are very similar, but they're not identical, and because of that key feature of the bonds really being individual pieces that can have distinct features. And one of the reasons this complexity really exists is that one is able to have different rates over time, and from an issuer perspective, that's advantageous. In a commercial loan, whether it's a home loan, a car loan, or something of that sort, the interest rates are the same whether it's the first month's payment or the very last month's payment 30 years from now. You pay the same interest rate on the outstanding principal amount. But in terms of investments and bonds as investments, because of the different risks that tend to expand over time, as well as how one measures opportunity cost over time, earlier investments that mature earlier tend to have a lower rate of return than long-term investments, and that's indeed what you see in real life. And this is one of those examples of this happening. I pulled this from a State Public Works Board transaction that was done back in April of this year. And here, sure enough, you see that the yields at the short end for bonds that would due very quickly were very low. They were less than 0.25% in comparison to the longest maturities, was more than 3.5%, more than 4%. And from an issuer's perspective, then it's advantageous to take full advantage of this yield curve, what they call a yield curve, by structuring the different bond components to have different rates of return, and segregating them such that the folks that you're paying back earlier, you're going to offer a lower rate of return than the folks that you're going to pay back a long time from now. And that really, from an issuer's perspective, being able to pay a lower rate, even though for at least some portion of the loan, even though the aggregate borrowing will have a very long term, is the chief reason that they're willing to put up with a lot of this added math that's necessary to model and structure a bond issue. Okay. And one will notice that the yield curve tends to be most different at the front part of the yield curve, and that also makes sense in the sense that you know, in the short end, when one thinks about it, you know, a one-year investment would have its duration be doubled when you're buying a 2-year bond, or you know, tenfold if you're buying a 10-year bond, as opposed to at the long end of the yield curve where things tend to be that if you're not getting paid the difference between 24 and 25 years, it's still just a very long time to most folks, and then people's perception of time, and that's why those yields tend to be very, very similar at the outside part of the yield curve. Yield curve is one of those things that's very often talked about, in terms of its shape, but it's generally not very firmly defined in terms of where the cutoff marks of what the various shapes are. What we've attempted to do to just make this, to help provide people of a guide with this, is to really look at actual historic data and provide some context and some levels that are relative to the near-term history of things. And what we're looking at here is a graph of an industry benchmark that's provided by Thomson Municipal Market Monitor, or TM3. This is the AAA Geo MMD Index, and it's published on a daily basis, well, each trading day, for each of the 30 maturities that typically exist in many municipal issuances. It reflects their interest rates, the prevailing interest rates of AAA-rated state-level GO bonds. And here we are graphing 5 observations from 5 different points in time to really show what some of the different yield curves have looked like. The 4 particular dates are those dates which exhibited, to some extent, the most of that particular behavior, and as well as we've included a set of rates in orange that reflects rates today. And so the 4 typical things that people talk, the 4 typical shapes that people talk about for yield curves are what people consider normal, which is a slightly ascending line that you see in green. What they also consider steep, which seemingly has been the case for much of the last 10 years or more. And that's marked in the blue line. We've also illustrated examples of something being very flat, that's the red line, and slightly inverted, which is in that burgundy line. Now recognize that burgundy, or maybe it's purple line, I recognize that purple line isn't very inverted. It just happens that this historical series of data for AAA GOs have never been very inverted, as opposed to some other yield curves that might have existed, such as for treasuries during a particular part in time, especially in the late 2006s, early 2007s. But that's partly a function of the types of risks and opportunity costs and other things that exist in the municipal market, where there's always a natural bias to have an ascending yield curve of some sort. And oftentimes people, this normal yield curve is already a slightly ascending structure, and because of the factors I just talked about, if for municipal rates, it tends to be even more ascending than some other yield curves, such as treasuries or LIBOR or agencies or corporate bonds or something of that sort. And so sometimes folks talk about there being a steep yield curve, but there isn't a real great sense as to what is it that's considered steep and away from just being normal, or what is considered flat versus what is normal. So what we attempted to do, just to give people a bit of historical context, is to look at some history of this data series, and to look at not only for these 4 instances what the rates and numbers were for comparing 2 points within the yield curve. So in this first row here, for instance, it's really comparing the 1-year maturity versus a 5-year maturity. And the second row is 1 versus 30. And then last row here is 1 versus 30. And then also show what it has been on average, the median, which is the 50th percentile, and what it has been, for the quarter percentile and 3/4 percentile. And arguably, if somebody were to have a yield curve where, for instance, 1 to 5 year is less than 52 basis points, or 0.52% here, one is arguably in a flat area, a relative flat area compared to recent history. All of these percentiles we've compiled based on, I think it was 24 years of data when MMD has been widely available. Then this provides some sort of historical context as to what yield curves are. And once again, it's because of the existence of these yield curves being able to borrow at different rates that we really look at and structure bonds in sort of this complex math models to take best advantage of that from an issuer perspective and still get a nice flat repayment pattern that one often sees being structured for financing. This first part is just an introduction to why bonds use loans and the particular math. I will pause here for a couple minutes, for a couple seconds, just to see if there are any questions about any of this before we move on to some of the more nuanced math related to bonds cash flow schedules.
Okay. Louis, at this point, we don't have any questions for you.
Okay. All right, great. The next thing we're going to talk about is how we go about calculating bond prices. This is one of those things that's fundamental to understanding bond math, and it is particularly relevant in the sense that municipal bonds tend to make much more use of the different features related to different maturities, different coupons, and yields, call features, and things like that that can affect this math and affect bond prices more so than our other markets. And at the end of the day, that bond prices is absolutely one of the key things that drive, that help factor into what the borrowing cost for an issuer would be. Now, in terms of calculating bond prices, the basis of all of that is really the time value of money. So we're going to take a step back and just talk briefly about time value of money, what it is, how it's represented mathematically, what its general purpose is, before we look into how bonds are being priced. The time value of money is really an attempt to value dollars that are in future in the context of what it would be worth today. It's frequently used to measure things like opportunity cost, inflation, investments, not only from a securities perspective, but investments in business, like buying a new system today to have cost savings over time and things of that sort. And the mathematical formula for the time value of money is presented in on this slide, with the PV equals being the present value equal to the future values divided by 1 plus and some kind of interest rate divided by a compounding period to the time or number of periods. The formula is structured this way to take into account the opportunity for people to reinvest interest dividends over time, and it's really intended, as the equal sign indicates, to develop equivalents for $2 values that occur at different points in time. And in the context of application for municipal bonds, the time value of money formula can be expanded to take into account multiple cash flows, a whole stream of future cash flows, if you will, by just summing the different pieces of that cash flow together to come up with a single value summing the pieces of cash flows, each of which happen at different times, to come up with a present value today of the overall stream. And that stream of cash flows is very similar to how bonds repay themselves, in the sense that there's periodic repayment of interest, and then at the very end of it all, there's typically the repayment of any remaining interest, as well as the final repayment of principal. And all of this leads to multiple terms. And for the municipal bonds, in particular, it's semi-annual interest, and the discounting conventions, as well as the time period conventions, is adjusted to be a semi-annual discounting, or that is 2 periods every year. And the day count basis is generally 3360 for the purpose of, it's based on 30 a period where in a single year there's exactly 360 days, and each month has exactly 30 days. And that's just a convention that exists for simplicity for calculations, but it has held even though, nowadays people's systems certainly could handle much more complicated math. And this time value of money formula is formally translated in the MSRB website in terms of its bond pricing formula, where there are components of it to take into account the principal part as well as the interest component, but also an accrued interest portion. And this is the official formula for how the MSRB, the Municipal Securities Rules Making Board, the self-regulatory body defining the rules related to municipal bonds, sets a description of how prices should be expressed as a function of yields. And all of these prices are expressed as a percentage of the principal amount to be exchanged. And the pricing is important because ultimately, from an issuing perspective, or even, I guess, an investor perspective, there needs an exchange of present-day dollars in order to receive their future cash flows for holding the bonds or paying interest and principal back on a bond over time. The same concepts introduced here also makes some of this math can make some of this math a little complex because, like I said earlier, there's such a use of different coupons as well as yields and maturities for municipal bonds. On this slide here, we are applying the formula that I just shown you on the previous page to 3 different examples. And here, in these examples, and the prices can vary greatly depending on the coupons and maturities that we're talking about. In these 3 examples, we'll sort of illustrate that. In each of these instances, we have a 10-year bond, and that's what we're talking about. But in the very first example, at the top part of the page, we have a bond with a 3% coupon and a yield of 3.15%. And that settlement, a bond of 10 years with such a coupon and such a yield, when calculated out, would have a price equal to 98.721% of the principal amount that's going to be exchanged. A similar bond with, but not identical bond, one with a higher coupon but a different yield, would calculate out to a substantially different price. Here you'll note that the price here to exchange and purchase for that bond is now, with 5% coupon, is now 115.764% of the principal amount to be exchanged. And that really, in order for the 2 prices to be substantially similar, a 5% coupon bond would have to have a very different yield than what the 3% coupon had. And when you solve it out, you'll see that it will have to be 5.165%. There's a lot of, and all this math is not very intuitive. I mean, there's a lot of digits here. The numbers are not nice round handles, and it is for that reason that much of the time pricing isn't discussed necessarily in terms of prices, but as yields themselves. I think in general people are better able to handle what those yields mean. And we're going to talk a bit about all of that in further detail a little bit. But before we leave this page, I just want to point out one thing, because some of these things we're going to be, I'm going to just make use of the terminology, and I don't want it to be lost on anyone what it is that a bond in which the price is 100 is referred to a par bond. A bond in which prices are less than 100, that's a discounts bond, in the sense that the face amount that you're going to get back at the end is 100% of the principal amount, and that when you're purchasing at a price of less than 100%, you're getting it at a discount, if you will. Even though it really isn't, because it's really, you bought it at a certain yield and all that, but the terminology of the art of municipal bonds uses that kind of wording. And if one would have a bond in which the price is more than 100% of the principal amount that's referred to as a premium bond. Okay. Now, this formula is already very complex looking, but actually there are even more rules related to the pricing of bonds and how that works, and that's what we're going to talk. Oh, actually, not yet. We're going to talk about first why it is that we use yields in further detail. Not only were the prices on the previous page difficult to handle in terms of the number of digits that are involved, but it also a lot of times it doesn't convey a good sense as to what the appropriate value for an investment is. As we saw on an earlier page, there is a general expectation that as one invests for a longer period of time on the same credit, all else being equal, there not being any special rules and things of that sort, that one would get a progressively greater rate of return, and that's what one would expect. And yields help to inform sort of consistency of pricing across different maturities. On this page here, I've tried to illustrate for folks why that is by showing that if we were just to talk about prices, it's not really something that one can readily grasp whether or not that consistency exists. On this page, we have graphed the AAAGO MMD from July 25th of this year, so a couple of weeks ago. And that's represented in that gold line there, and the numbers are shown on the bottom there for the first 10 years. And as people have, as bonds have different prices, at different yields, it leads to different prices. And if someone were to have, looking at this left-hand example in red here, a 2-year bond with a 5% coupon, and they were told that that fair price of that is 109.5%. And then they were also informed that a 4-year bond with a 3% coupon, a fair price was 108.5%. A quick look at by somebody not appreciating the calculation to yield and all that might lead one to believe that a fair price would sort of be an interpolation between those two prices for a 3-year bond with a 4% coupon, because after all, 3 years is perfectly the middle of 2 years and 4 years, and 4% is perfectly in the middle of 5% and 3%. But actually, that price of 109 for a 3-year bond actually generates a yield that is substantially, when you graph and you look at it on a yield basis, substantially different than what one would expect to be a fair rate of return for a particular bond. And this depiction of how these numbers work out is really why people talk about things in terms of yield, because it is with it one is able to get a true sense of the economics of a particular bond as an investment, whereas the prices can sometimes deceive you as maturity ranges changes and as coupons change. The right-hand side shows much the same issue, and here we just have a slightly different numbers and slightly different maturities, and it goes to show the same problem in that just interpolating things, which is how one would, in theory, think about it, that doesn't necessarily lead to the correct results. And that's why everything is expressed in terms of yields, so that across different coupons and maturity and nearby maturities, one is able to have a sense as to whether something is relative fair value. Now, as I was talking about, the bond pricing formula is already quite complex in having a lot of numbers, inputs into all of that. But actually, that's not the end story for how municipal bonds are priced. In order for one to speak in terms of yields that are rounded to a fair number of digits after the decimal point, but at the same time to make sure that the amount that ultimately gets exchanged at the end of the day after there's an agreed upon yield or pricing it's important to make sure that all the very specific details like rounding and things of that sort tie out precisely correct. And there's also some nuances in terms of how the formula works when coupons equals yield, as well as the callability of bonds that require additional rules to be put into place. And there are generally 4 rules that go into making the adjustments for pricing municipal bonds. The first of those is that whenever the coupon equals the yield, the price is set to be 100%. That's just the way it is. If you actually plugged in different numbers into the formula we talked about, sometimes you'll get perfectly 100, but oftentimes you would come up with a solution that is slightly off from 100, most often 99.998 or 99.999, which is, very close to 100, but at the end of the day, when you're talking in exchanges in $100 million worth, multiplying it out, that's $1,000 or $2,000, so about $1,000 or $2,000 that they will be off by, and that's something that's not desirable. So by definition, that's true. Another aspect of that is that when one plugs in numbers into those formulas, they're going to come up with a result that looks very much like the 2 examples here, where there are many, many digits after the decimal point. And the convention for municipal bonds is truncated to the 3rd place after the decimal, so that even though there's all these additional digits behind here, and even though it may be that, the 3rd place after the decimal in the second, the example is the one I'm pointing at right now, would normally cause it to round up. By convention, we just cut it off. That's it. We only look at the first 3 digits, and that's all we look at. And that's just a convention, and I suspect that probably had to do with the efficiency of early day calculations for bond prices with certain yields and things of that sort. Then on the flip side of that, when we're talking about yields, the convention is just to round it to the 3rd place after a decimal. So such that, if the 4th digit after the decimal point is more than 5, that 5 or more, then the digits would be rounded up, and that's what we show in the example here. In the second example here, in the first example, the number is less than 5, so it's rounded down per normal rounding. And this is slightly different than the way prices are treated. That's the 3rd rule. And the 4th rule is something that happens for municipal bonds because it is so often a feature of municipal bonds to have them be redeemable at a certain price prior to the maturity at the sole discretion of the issuer. And because it is the sole discretion of the issuer that this happens at, and certainly for a primary market issuance, it's not unreasonable that the initial investors get the benefit of the doubt in terms of the price, how price is determined, as to guarantee the yields that had been negotiated. And what that really means is that for optionally callable premium bonds, optionally, not mandatory, mandatory too if they also happen to be optional, but certainly the optional is the most important part of it. And their premium bonds, that is coupons are greater than yields, something we talked about a couple of pages ago, that the bonds are priced to that call date and call price, which results in the lowest price. By making sure that the initial investor pays the lowest price, that guarantees that he has the best yield. Price and yield, although I didn't show it anywhere here other than intuitively what was displayed in the formula, have an inverse relationship. When you pay a low price for something and you're getting a fixed set of cash flows, when the lower your price, the higher your rate of return. And so by doing this such that we for optionally callable premium bonds, such that I have the lowest price, we guarantee that the investors have the best yield. Because once again, it goes back to that the investors didn't have any say in whether or not the bonds are optionally redeemed. That's really the sole right of the issuer. And as a result of that, the convention is to give the investors a benefit of doubt. And to make secondary market trades exactly analogous to primary market trades, that is, trades amongst investors, be the same as that first trade between issuers and investors, the same rule applies. The lowest price is always guaranteed to the buyer, for the advantage of the buyer, not the seller. Here we've illustrated an example of a little bit of a more complicated bond. So a November 1st, 2028 maturity, 4.2% coupon, 3.15% yield. It's callable in about 10 years from now, because we're settling it on November 1st, 2014. Callable in exactly 10 years at 102%, and then in 11 years at 101%, and then in 12 years at 100%. And given all of these different permutations and things, one has to evaluate what the prices would be implied for each of these different scenarios. Scrolling back a couple pages, you'll notice that one thing I just want to point out is that what is talked about here, there's this concept of rather than just principal amount or 100%, is that there's this redemption value that's used as the basis. As you have different redemption values, meaning if you have call premiums involved, these are the numbers that would be put in place for the purposes of this pricing formula. And when you work out all the different scenarios, so you assume the redemption date is on the first redemption date at 102%, so that's 20 periods, or if you assume it happens in 11 years, 22 periods at 101%, or 12 years at 100%, or at maturity, so for 28 periods or 14 years at 100%, you price out each of those scenarios and you take the one that offers the lowest price, and that's the convention for pricing municipal bonds. Now, one thing to recognize that many of these bonds are continuously callable. They can be callable any day after the first dates that are stated. But really, from a math perspective, that's not only an owner's chore to do all of those calculations, but it's really only the first dates when the redemption prices change that you have to check. Well, as you move out to later dates, like November 2nd of 2024 or November 3rd of 2024, you'll find that all of the prices will price higher until the step down in redemption values. And because of that, the nature of that, then it's not, and the full knowledge that that's going to happen, that's not necessary to change, to check every single period, but it is important to check every single unique period in terms of when redemption prices change, and then to take the lowest of all these. And in this particular instance, I've picked rates and dates and amounts such that it happens to be one of the middle ones that does that. And that, in a nutshell, is some of the bond pricing conventions that when coupled with that bond pricing formula, goes into figuring out to translate yields of bonds into prices to be exchanged, upon which the basis for the exchange of monies would take and securities would take place. Now, capital appreciation bonds are also based on sort of the same principles, and the pricing for those works similarly. It's still based on the time value of money. It's basically, the major deviation there is really that the denominations are sold in amounts such that with the final value to be repaid at maturity is going to be in denominations of $5,000. And as a result of that, folks have several different ways of expressing that concept. Some people choose to say that the face value is always $5,000, and that prices are, and that's really probably the most common way, and that the prices are based on fractions of that $5,000, and then people trade in multiples of those $5,000. But the formula works very much the same way in that it's the value at each instance in time, the created value over time, or the AV here. It's really based on the yield divided by 2 to the power of the number of periods, and that's very similar to what we saw for regular current interest bonds. But keep in mind, it is possible for people to express capital appreciation bonds at prices that deviate from what I just described in terms of fractions of the $5,000 denominations. People do sometimes use different accretion values than yield, the accretion rates than yield, and that complicates the math, but this is the general formula for doing it. And in the next page, we have just simply shown you a calculation for capital appreciation bonds, how it works to generate an accretion table. And here we have an example of something being delivered on May 14th, 2014, a maturity of May 1st, 2019, 3.5% yield. It is in a maturing denomination of $5,000, and when you work backwards, you'll be able to see all of the different accretion values that exist using the formula above, and what it was exchanged per $5,000 of maturing value at initial settlement. And that is really a summary of how bond pricing formula works and the conventions related to bond pricing in order to translate yields into the prices. And I will pause here to see if there are any questions from anyone about any of this.
Well, again, Louis, you are doing such a fantastic job. We don't have any questions for you.
Okay. All of that very detailed discussion about exactly how bond pricing works leads to and flows into how people construct cash flow schedules that are used to describe and memorialize a bond issuance.
Louis, did we lose you? Sounds like we did. Can we just hang on and we'll get Louis back online here and we'll keep going. Louis, you're back with us?
I am still here.
Okay, we lost you there for a moment, but we've got you back, so go ahead.
Oh, okay. I apologize. I just start from scratch on this page. I've excerpted 3 schedules that often appear in official statements or prospectuses for a particular bond issue that describe basically the math that characterize a set of bonds within that issue. The various cash flows issuers often are used to generate these tables, and when all is said and done, these terms are the ones that issuers have to live with for the life of these bonds, or until they're redeemed, and benefit from the proceeds and things of that sort that are generated and represented in these 3 schedules. And now what we're going to do is really talk about and apply some of that bond pricing that we've just been talking briefly about in order to have a better appreciation of how the various numbers in these 3 schedules relate to one another, and hopefully with that understanding, one can better appreciate how to read the schedules and also some of the underlying relationships of what drives what. And the three schedules really are, what on an individual maturity by maturity basis, what the principal amounts, the coupons or the interest rates, as it's often written in an official statement, the yields of each one, so sort of the bond pricing results, how they relate to the debt service schedule, which shows the principal and interest payments to be made over time, and how it also relates to sources and uses, the amount of proceeds that are being generated from the sale of these particular amounts of bonds, and how those proceeds are being applied for different purposes. So what we're going to start with is, because once again, the whole entire bond issue is really just about having a particular loan, a single loan. So what we're going to start with is a very basic, just a simple loan, $50 million with a 5% interest rate. It's to be repaid in 5 years. And when you have a typical loan like that, we have, the original dates of when the loan was made to somebody, when they are expecting to receive payments, and sort of what the payments are each and every single one of those periods. It's possible for one to divide each one of those $11.5 million payments into a principal and an interest portion, and such that it would be that over time the principal balance goes down to zero and sums up to the original amount borrowed, and that and still preserve this debt service amount. We're going to make small tweaks to this to show the analogy of how this would be reconstructed through a bond issue with all of the nuances related to a bond issue. And the very first thing that one has to tweak, because the bonds are securities that can be traded in readily interchangeable denominations, typically multiples of $5,000. It's around the principal amounts that are involved to the nearest $5,000. And that's really necessary in order to make sure that there isn't some leftover pieces for folks that make it difficult for people to exchange them. And it's really that whole function exists to promote the trading of those securities over time, and to make it that each and every single bond are identical from one another from a bondholder's perspective. After that, we're going to take into account another thing which we had talked about earlier in a different slide, which is the fact that the bonds themselves could have, because each bond is a separate maturity and has a certainty of payment on that maturity date in terms of principal and then interest leading up to that, all the different times before, is that there's a possibility to have different interest rates. So rather than the single 5% rate that we had shown for the loan, here we've showed that the 2015 piece has a 2% rate, the 16 piece has a 3% rate, the 17 piece is 4%, 18 and 19 piece, each one has a 5% rate. And what that really means, as a result of that, we have different interest amounts that get calculated on just corresponding to the outstanding principal amounts. So here you see that $285,000 of interest is being paid for the $9.5 million of principal that is due, that will be repaid in 2016. And here we're just aggregating the semi-annual payments to show them only yearly. So over time, each year, there's $285,000 of payments related to that. But because you have 5 separate bonds, the total amount of interest is all of those added together. And that's what the total interest column is. And frequently, you'll see this math here in this particular section being in a shorthand basis not shown, and shown in this more familiar form, where you just show principal, coupon, and then the interest, and then total debt service. Now, when you look at that previous slide, one of the things you notice is that the debt service payments aren't perfectly level. And it is possible to rejigger the amount of principal amounts in each maturity such that one can get on almost level debt service profile, similar to how the loan worked. And the reason that it's not perfectly normal is that it's not perfectly flat and exactly the same each and every single year is because the principal amounts themselves are rounded to the nearest $5,000. And since the interest rates are just multiplied against $5,000, there's limited control to make it precisely the same across each and every single period. But what you'll also notice is that the amount of debt service from the biggest to the smallest amount doesn't deviate by more than $5,000 either. And again, the bottom part of this page is showing all of this in a more familiar form. Now, the next aspect of that is to recognize that because coupons and yields don't have to be the same, and as a result, prices are not necessarily 100% of the par amount involved, that has to be introduced as part of structuring a bond issue. And here we taking some of the ideas and formulas from an earlier page where we show that there are different yields here for each maturity corresponding to different coupons, and the resulting prices expressed as percentages of principal amount, and then proceeds, which is the product between the principal and the price in order to get the proceeds. And that the sum of the proceeds for this $50 million of principal amount is the amount of money that gets netted from the sale of these particular bonds. And so in this case, because the yields are all in each maturity are less than the coupons of the bonds, every single one of the prices are more than 100%. So unsurprisingly, the amount of proceeds is more than the amount of principal shown.
Hey, Louis, I've got a question for you.
Sure.
For financial reporting purposes, specifically the MD&A and notes on a financial report, what yield or rate should you use for multiple coupons when you have a bond with multiple coupons?
We're going to talk about that. In this, typically what people use is something called the true interest cost. That'll actually be the calculation of which, and the basis for why we do all of that will be something that we actually show you how that is done. But in the cash flow package that people put together and report at the conclusion of a bond sale, will typically have that as one of the statistics. But that's what you would use typically. There's that, and also depending on the schedule, sometimes it makes sense to report it on the average coupon of the bonds. So, and that's also something else that we'll show how that's being calculated as well.
That was it then. Go ahead.
Okay. Of course, when one goes about selling these bonds, there's a whole bunch of consultants that gets hired, including one of which is the investment bank or the underwriter for the bonds, and they'll need to be compensated for their efforts. So the proceeds of that $52,642,000 and $532 we've just shown you isn't actually the amount that's going to go into the pocket of the issuer at the end of the sale. Instead, what happens is typically there is a amount that's what they call takedown, the compensation, used to pay commissions for their salesmen to keep the lights on at the investment banks and for their profits, which is basically typically expressed in a dollars per $1,000 amount, what they call per bond, even though municipal bonds, typically each bond is $5,000, but in the rest of the markets, in the rest of corporate markets, treasuries, and things of that sort, the typical denomination is in multiples of $1,000, and as a result of that, the wording is per bond, even though it's per $1,000 as opposed to per $5,000. That is paid to underwriters in addition to certain expenses they may have. So what they have then is to take down the dollar amounts would be, in this case, for this maturity, it's $1 per bond, $1 per $1,000 issued. $9,415,000 are issued. And if you take $1 per $1,000 of that, that's $9,415. That would occur for each and every single maturity. You can have different takedowns for each maturity. And the total amount of takedown that's compensated to the underwriters, the sum of those amounts, which in this case is $137,240. In addition to that, there's a variety of expenses that may be involved, all of which they expect to be compensated for. And when you net that amount back, that's the amount that becomes the purchase price of the bonds. That is, the underwriter will pay this amount to purchase the $50 million of bonds with these coupons. And then when they do that, that reflects the yields at which they will resell in public, as well as their compensation, as well as certain expenses they've incurred as a result of the sale. And then not only do the underwriter's discount factor into this, a lot of times there is the need to dispose of different funds, or there may be funds on hand that's available ahead of time to affect the cash flows of the financing. In this particular example here, we assume that there was $1 million of funds on hand as part of this financing, that we have to have fund a reserve fund. We have to fund some kind of cost of issuance. And net, the production amounts here of in aggregate is $53 million and so forth. But if we were to try to get $50 million of project deposit, which is the original principal amount we sort of indicated, after setting aside some of these other funds for the reserve fund, cost of issuance and underwriter's discount, there isn't quite enough, and which is what results in this negative contingency amount that we see here. And to fix that, what ends up happening frequently is that the principal amount of bonds is adjusted such that if it were that the contingency is negative, that is, we didn't have enough money, the principal amounts are adjusted for each maturity as to go up until it is at such a point that the target amount proceeds is what you want, and that the contingency amount is a minimal amount. Typically, this amount will be between $0 and $5,000. And at that point, that is sort of all of the different aspects of a bond issue put together in terms of how it goes about getting structured to equate a bond issue to a loan. Of course, there's a lot of numbers flowing around and all of that. And one of the things that I asked about, just like the question that just came up, was really, well, what was the borrowing cost for the entire loan transaction? That's one of those things. People can typically sort of grab their hands around, the total principal amount that was issued was $52 million. The total amount of interest we're going to pay over the entire period is, in this example, $6.9 million. But there's some of that math that, at the end of the day, people would like to see, just like the fact that prices are not easily understood. Sometimes it's meaningful for people to see it as a single borrowing cost. And there's a variety of statistics that express that, the three most common of which are what they call the arbitrage yield, the true interest cost, and the all-in true interest cost. And each of those follow the same, generally the same method to calculate, and they are basically the internal rate of return on debt service or expected debt service on the bonds to such that that is the rate of return, internal rate of return, which will equate the stream of debt service payments to some target, some initial amounts. Typically, that could be, in the case, for example, of true interest costs, what the original exchange between the underwriter, the initial purchase of the bonds initial would be. You'll recall that the purchase price, that's what that by definition is called, is the total amount of proceeds generated. So the principal amount plus the original net premium or discount minus the underwriter's discount. So here the $54 million that we saw a couple pages back, such that when you discount the debt service cash flows at the true interest cost here, the 2.65880%, you'll end up with a P value equal to 54,532,000. There are slightly different rules as to what gets deducted from what to measure people's borrowing costs, but the most commonly used form is the true interest cost here. The arbitrage yield has special rules in it, and it's really related for reporting to the IRS in order to preserve the tax exemption status of many municipal bonds. And the all-in true interest cost people use because people recognize sometimes that not only is the underwriter the only source of deductions from a deposit available to the underwriter, but also cost of issuance is a factor as well. And it follows very much the same scheme, but the target amount that's being used to generate the internal rate of return is slightly different. For averages, which is another related topic, it follows a slightly different method, but is often also a helpful metric to express things in an aggregate term. And on a very in a simple way of putting it is just that it's just a weighted average. For instance, when we went to calculate the average coupon, each maturity had a principal amount and a coupon associated with it. To figure out the average coupon, it's simply the sums of the coupon weighted by the principal amount. So each one of these principals would be multiplied by the coupon, as shown by principal multiplied by coupon here in yellow. You add them up, and then you divide by the original principal amount to come up with the average coupon. It's also true, but that's how you figure out what the weighted average maturity is for a typical bond. And those kind of statistics help summarize basically the terms of an issue. One to describe this issue would say, there was a $52,145,000 issue. The average coupon is 3.85%. The weighted average maturity is 3.06913 years. And that, in a way, it encapsulates the whole issue with a single set of statistics.
Louis, I want to give you a time accounting just to let you know if we stay on track. We've got about 20 minutes left.
Okay, thank you. Are there any questions at this time?
Not yet. We'll keep you posted.
Okay. One of the things that we sort of just glossed quickly over in the previous example where we dive deeply into doing the particular, each of the particular numbers is the amortization structure of that bond. In that particular bond, we had chosen one of the most common structures, which is to have level debt service. But there are really a variety of alternatives to doing that. Over the next 3 slides, we're going to illustrate 6 of those different examples. There's no particular magic about any particular one of them. I think the pictures describe exactly what they are, and they are that way for their own purposes. The first one of these is level principal, and the reason that this was done is really for ease of calculation. It was a very common structure back in the day when people had problems. It was very difficult for people to figure out how to do level debt service on slide rules and things of that sort. And in that structure, as a result, that's the same principal amount being paid each and every single year, and the interest declines over time because the amount of outstanding principal declines. It is still a common method of amortization for bank products with term out provisions, as well as for GOs. In the former case, because it's common because not that the math couldn't be done nowadays, but it's still easier to do it that way when the amount of the drawdown loan, for instance, for a bank product can vary over time. It's just easier just to say, well, you're going to make 10 equal payments to me in terms of principal, and the interest is the interest. And this is one of those scenarios where because the principal is paid off relatively quickly, the ratio between interest and principal is relatively low. The second, and probably the most common structure nowadays, is level debt service. And the reason people do this is that it distributes the costs evenly over time. It makes long-term budget preparation easy. If you have a certain amount of debt service you have to plan for a certain year and you are able to afford it, then the next year and the year after that and the year after that, at least that particular line item in your budget is going to be the same. And in the current market, based on, this is all based, I think, on 5% rate on for 30 years, this will result in an interest rate that's the principal ratio that's slightly less than half. And it's really, once again, the whole, you pay more principal over time because the amount of interest declines over time, and it's intentionally structured that way. Another common structure is to defer principal for a small period of time. This is appropriate for those particular financings where maybe something comes online, it doesn't even get finished for 2-3 years or whatever it might be, and that there may be revenues associated with completing that project. And when that becomes available, then the additional revenues or cost savings could be used and applied to fund debt service. And that's a commonly appropriate structure for such purposes. Another scheme that frequently is used is ascending debt service, at least modestly ascending debt service. In this case, we did 2% annual growth. You know, the reason people do this is really that cost recovery mechanism, rates you charge, the sale volumes or whatever it might be, the assessed value on the property or something of that sort naturally grows over time, or just to reflect inflation, and that becomes a reasonable proxy for doing that. What you'll notice is that as the principal amounts are getting pushed later and later, the portion of the payment that's related to interest in comparison to principal amounts goes up. And that's not surprising. Interest exists as long as principal is not being repaid. And the more, for the longer period of time which you defer the repayment of principal, the amount of interest goes higher. And the two other common structures is one is what's known as backloaded principal. In this case, we did an extreme, which is to push everything to the very end. This is commonly done for when that particular type of debt ends up being something that people believe has the lowest interest cost for themselves. The idea it would be that this front portion here, this empty space part of the L, would be filled in with a complementary issue, which would be a borrowing at a higher interest cost, as to create a box, if you will, that one would see for the level debt service structure anyways. And any opportunities that people believe that they have to arbitrage something or something of that sort, that's a common feature. But once again, the interest to principal ratio goes up because principal is being deferred. And then last of this is similar to what I just talked about, is wrapping the debt service. And here in this particular example, we had some existing debt service, hypothetical existing debt service for this example, and we structured something so that the whole thing at the end of the day looks like a box. And this is a common strategy for something that you're refurbishing something so that you extend the useful life of it, and it's an appropriate application for that. So these are 6 of common amortization structures that exist in the marketplace to fit the particular needs of the issuers. The common theme here is that the interest to principal ratio goes up over time as things get deferred, and when picking one of these structures, is really there should be a rationale that matches sort of affordability, maybe when revenues come in or something of that sort. That's a good reason, rather than just oh, let's just defer because we don't want to pay something yet. in terms of the principles of good government. One of the things I had glossed over in going through the detailed math related to the structuring bonds as a loan was really how one goes about solving for an amortization structure. And on the next few slides, we're going to go just very quickly through how that is done. But essentially, it really goes back to how a debt service formula exists, where the debt service is equal to the sum of the principal that's being paid, the interest on the principal that's due, as well as the interest on any principal that's still outstanding. And that's this formula here in the top part. And then really to figure out how much principal one would amortize in a given year, provided you know how much debt service you want to pay, it's really rearranging this formula algebraically and then plugging in the various parts you need to solve that equation. And after solving this algebraically, and if you had a target debt service number in mind, you know what kind of coupon you need, you will be paying for a particular maturity, and what other coupons and principal amounts might exist in later maturities, you can go about starting plugging in those numbers. And typically, the first part of that number is really at the very end, the very last maturity. So you start from the bottom up, because that's the one place where there are no unknowns. In this particular formula, a lot of the terms get reduced to zero in terms of the principal amounts that are still outstanding after me. The coupons that are applicable bonds after me, there are none, so it's all zero. And when somebody does that division and you figure out how much principal amount there should be, you do a bit of rounding to the nearest $5,000, which is what we also talked about, and you can come up with, if you wanted to pay $5 million in debt service a year and you were paying a 5% coupon, that would be having to amortize $4,760,000 in principal in that year to get that done. And as you go through each earlier maturity, you are provided with all of the information you need from the previous solution, and you continue just to solve the question. Here, you'll notice that the solved principal amount is lower at only $4,545,000, and that reflects that there's $238,000 of interest that must be paid on a later maturity. The process of solving is just the exact same as the last step, but you're filling in more numbers. And over time, you just keep going and repeating the process, and when you do that, you can come up with a principal schedule that fits what the target debt service level is. Another aspect of the amortization structure was really that sometimes target proceeds number don't match. And to solve that, what one goes about is an iterative process, whereby if you end up with too few proceeds, you increase the amount of principal. That makes sense. The more principal you have, the more proceeds you generate. And after you make the necessary deductions for expenses and so forth, and other monies to be set aside, it may be that gets you the right amount. Or conversely, if you have too much proceeds, you will reduce the principal amounts you need to issue until that's the case. And what happens is very simply, what one does is you have a first guess at how much your target debt service amount is, and what your target proceeds amount is, and what your first result was trying that known debt service number. And to the extent that that doesn't perfectly match, when you plug in this formula, it'll give you, that should be your next guess in terms of debt service. And you sort of iterate the process. And sometimes it's helpful if you're too far apart to take steps to interpolate, which is what this bottom part is, and to try to help you find a solution. And over time, progressively, one can get to an answer. In this example, we had the same number as that we had before. We ended up with plugging in the numbers. We needed to have, we wanted to have, I think, $40 million of target principal. It wasn't quite what we want. So because we only had $39,065,000, so instead of trying flat $5 million of debt service, which is what we started with, we would charge slightly more. And as you continue that process, it will get to a point where the resultant principal amount is exactly what you need. And that's how you go about doing that, figure out what the target proceeds amount is. And at this point, I can talk about the Excel functions because all of these models were built with Excel, but I'm also happy to take any questions that people might have about some of the topics here.
Louis, looks like we're still without any questions to feed you. Oh, we're getting something. Hang on. Nope, sorry. False alarm. Go ahead, Louis.
All right. All of the cash flows here were really built with Excel, and I know that some of the things here might have seemed a little difficult to follow, especially if this is the first time you see many of these things. But I assure you that with practice and with a little bit of ingenuity effort, one can certainly figure out how it all works. And I think some of the tools that's necessary to do that, I've attempted to lay out in this series of the most essential Excel functions and how to use them for the particular application that we need. We'll begin with the price function, and it really, at the end of the day, that answers a lot of the problems of what people need to know to figure out how to do prices. And really, at the end of the day, there's already a built-in price function in Excel, but it's really the additional rules that I laid out in terms of the bond pricing conventions that need to be accounted for that are not built into part of the standardized function. And that's really accounting for par bonds, rounding, and call provisions in the case of premium bonds. And the formula at the bottom here shows all the different terms that's necessary to reflect how to do a price for a standard par bond callable at par, and to make sure that works. So the first part is really that we need to make sure that the coupons and yields aren't equal, and if they are, then the price is 100. We use the truncate function to round things down to 3 decimal places when necessary. We do in terms of figuring out what is the correct redemption term to put in, the redemption maturity to put in for the price function, we use the logic of figuring out, okay, 1, you have to be after the call date, and 2, we have to be a premium bond. And if both of those conditions are true, which is what the AND does, then we would stick in the call date rather than the natural maturity. And with all of these fields together in aggregate, this is how you figure out a price for a bond callable at par. And this is a highly flexible formula for doing that. But if it happens that your redemption terms are more complicated, where you have multiple call prices and call dates, it may be necessary for one to individually calculate each and every single price, make a comparison using the minimum function, doing the truncation, doing the checking for whether or not you have a par bond, to have a formula that can accommodate all of the provisions necessary to do and figure out price. And that's how all of the prices were figured out in the examples I presented in this presentation. Okay.
Louis,
another aspect. Sure.
Oh, I'm sorry to interrupt. I got a couple questions if you want to field them now, but we could also wait till the end if you want.
I can field them now.
All right. The first one has to do with term bonds. Apparently the taxable market prefers these. The question is, why is that the case?
Term bonds are really structured to provide a trading vehicle for folks. At the end of the day, most bonds that are sold to investors are resold by those investors. Hardly anybody holds something to maturity. There's a lot of trading going on as people face redemptions if they run a bond fund or see market opportunities. And why term bonds exist is to try to create larger amounts. We talked about earlier here where the reason we have all this complicated math for municipal bonds is because we can take advantage of the yield curve and borrow at lower cost where we intend to repay something earlier. And by and far, the municipal market is the most fragmented market there is in terms of bonds. In the U.S., most corporations, except for the very large ones, borrow money through banks and syndicated loans and things of that sort. Very few people actually sell securities to have actual bonds. There's only something like 500 corporations that have publicly traded bonds, U.S. corporations, in comparison to tens of thousands of municipalities that sell bonds. And in order to create a vehicle that's more analogous to what corporate market investors or taxable market investors might have, one has to make the deal seem less fragmented. In a typical, for instance, in some of these examples I had, in a municipal bond issue of 20 years could have 20 maturities if there was only one coupon per maturity. Sometimes there's even more than one coupon per maturity. So a single 20-year loan now becomes 20 pieces. And from an investment perspective, it's difficult for one to find trading partners for exactly the piece you want. But however, if it were that all 20 pieces were aggregated to one piece, then you are more likely to find a trading partner because you probably weren't the only guy who bought those particular securities. You can check with the other people who bought those securities, see if they have any interest in buying those, what you might be holding. And that's why term bonds are such a common thing for taxable bonds. It really has to do with a function of trading. It has to do with the fewness of the credits that exist in the corporate market in comparison to the municipal markets.
Okay, so the second question has to do with premium bonds, and the question relates to the difference between the bond proceeds and the principal amount.
Okay, in a premium bond,
and so the question really is, why are the proceeds greater than the principal amount?
Okay. When we first talked about how bonds are priced, we talked about how all of it is based on time value of money. In the municipal bond market, it's quite different than the corporate market in that the coupon on the bonds at initial settlement is rarely the same as the yield. In the corporate market, typically when the issue happens, the coupons and yields are the same, even though over time, as interest rates change, the yields can change quickly and things of that sort. But for a variety of reasons, some of them related to accounting for tax rules on the parts of investors, some of it is just additional hidden economics and things of that sort. The coupons on the bonds for municipal bonds are rarely the same as the yields. And for that matter, for any bond really, as interest rates change, the yields should not be expected to be equal to the coupon. As interest, even for corporate bonds or something of that sort, where initially the coupons and yields are equal, when interest rates change, the yields are going to change over time. The coupons themselves don't change because that is what is memorialized on paper as in terms of this is the set of cash flows. This is the basis for calculating how much interest I'm going to pay you over time. And it's static, and for fixed rate bonds, it's set. It doesn't change over time. So what happens is for premium bonds, you are agreeing to pay somebody a coupon rate that is in excess of the fair prevailing interest rate over time. So using, let me see, I'm going the wrong way. Using this example here on this page, the middle example here, the fair price at this point, the fair interest rate for the particular example here is a yield of 3.15%. But you're agreeing that over time you're going to pay them a coupon of 5%. not only are you agreeing to that, but at the end of the day, you're going to pay them back the principal amount that they're saying that they're going to borrow from you. In order for the exchange to be fair, the person would have to give you more than how much you're going to pay them at the end in order for the exchange to be fair. Because over that entire period of time, the semi-annual interest payment period, you're paying them 5% when the fair prevailing market rate is only 3.15%. So that difference is really why in premium bonds, that is when coupons exceed the yields, that the amount exchanged at delivery is expected to be that the buyer pays more than the par, more than 100% of the price of the bonds. Okay?
Great, thanks, Louis. Got one more now having to do with the examples. Let's see, please repeat where the slides are located and which examples in your presentation would be good to use the Excel formulas.
The Excel, all of these, starting with this slide 21 here, all of this was built using Excel formulas. Here, I'll go through some of the other things, but the dates and how those are computed is all based on one date at the top as opposed to entries. The interest payments and all those things are calculated using the formulas. The prices here on this page 25 use that price function I just talked about. So all of this example in reconstructing all of this is very possible through using the Excel formulas that's laid out.
Great. That was an excellent way to handle it. Thanks, Louis.
Okay. Any other questions?
One of your examples included a sinking fund. Can you talk a little bit about what a sinking fund is?
A sinking fund is that part of the term bond that an issuer obligates itself to repay a certain amount of principal prior to maturity. It's really a structure to allow for the sort of the boxing, if you will, as shown at the level debt service here at the bottom of the page, the boxing, if you will, of a debt service schedule when you have term bonds. If it weren't that you had these sinking funds, then one wouldn't have to, for a term bond, then one wouldn't have to pay until the very end. And it would be some huge payment. And in fact, the original, municipal bonds or municipal style bonds for railroads, that was frequently the case. And what ended up happening was all of those, when the principal was due, those railways went bankrupt, and those didn't get repaid. And to make sure that that didn't happen, to make sure that there was always sort of a setting aside of money, making sure the investors are paid over time and to even things out, people decided that, yeah, even though I'm going to have these term bonds that aggregate everything to allow for trading, which is the answer to my first question, we would have these sinking fund provisions where the issuer is forced to repay pieces of it at a time. And that's what a sinking fund is. Any other questions?
Not at this time, Louis. And I do think we're butting up against our time limit here, so I'll ask you to finish up with what you're able to handle.
Okay. This is only a couple of slides, and I certainly understand if folks are going to leave us. But if you do have time, I think it is helpful, especially if you want to try to reconstruct some of the schedules that I alluded to starting on page 21, slide 21 before. Here we make generous use of what is the e-date and e-month functions. And ultimately, the Excel help will be very helpful, would be very instructive in how to use all of this. But making one aware of the existence of these functions are also helpful to figuring out how this works. The EO month reference, that's the end of month function, allows one to say, put in a date, in serial format, and then to move to the end of the month, that many months away. So if you had put a 0 here, it would be the end of the month the same month, but here by putting in a 5, it's end of the month 5 months from this original date. And then by adding 1, you can get to the first of the month in the next period. And E-date here does allows for one to quickly, formulaically express periodicity. And here, what the E-date does is it takes once again a date in serial format, in serial date format, and offset it by that many months. So 1 being 1 month away, 6 being 6 months away to reflect semi-annual interest periods. And using these functions, one can create very, very long schedules fairly easily without having to rely on Excel to auto-detect on a drag down or something of that sort, and to make the formulas consistent. Another formula that was used and then helpful as a simplifying step is what's called sum product. And as the name implies, what it does is it sums products of things. So what this is helpful for is really in the calculation of interest, because once again, when one simply expresses interest as the aggregation of the different principal amounts and different coupons that can happen over time, it sometimes gets unwieldy to keep doing the calculation, and some product helps you by expanding out the number of cells. It gets unwieldy to do that. Some product allows you and a judicious use of the $ to lock the relative residence of arrays lets you be able to quickly structure a calculation for the purposes of calculating interest. And in this particular example, this $37,850 reflects the principal and coupons, all of them combined. The one tip about this is this function fails when the last cells are blanks. So just keep that in mind. If in case it's not working, that could be the reason why. And the last of the formulas that that I want to talk about is really year frac, and this is really helpful for calculating interest and other things where the date is not regular. So if we have a bond that is dated the date of issuance, and that doesn't happen to be exactly 6 months away from the first interest payment, that is often used to sort of figure out how to offset the interest amount by the correct amount to reflect the number of days that weren't part of the period, or maybe were extra, as the case may be. It's also helpful to do accounting for actual basis, and sometimes that's necessary, especially when you're talking about leap years, when you're talking about paying at the beginning of each month, but then having to take into account, how things work for July, August, things with 31 days versus 30 days versus, February and all that kind of stuff, and things get irregular. That's an easy way to handle all of that. And that is the end of my presentation. I'm happy to take any other questions, and if some folks have questions, I'm happy to take them if time allows for in the next session, at the end of the next session, as well as if you just email me, I'm happy to answer some of the questions as well.
So, Louis, we don't have anything at this time. I do want to point out that the Excel formulas and the examples that you provided complement the conceptual discussion with regard to bond pricing, amortization, and I encourage people to utilize those as a way to explore the concepts, not to particularly look to them as tools that you may employ for your work. If there are questions about the spreadsheets themselves, Louis, would you be willing to entertain them from folks?
Yes, provided it's not hours and hours, yes.
That's what I'm trying to avoid, a search for solutions that people are dealing with in their work specifically. As I said, I think they complement the concepts and can be used to better understand the concepts that were presented. So. Okay, again, if you desire a certificate of attendance, those will be emailed to you, as will a survey, a questionnaire to help us evaluate the program today. since we do have a Part 2 coming on, I encourage you to fill out the evaluation, help us resolve any issues that people want to address in the second program. MCLE credits are available. Again, email us at cdiac_education@treasure.ca.gov and we'll get those out to you. A video and transcript of the webinar will be available on our website in the near future. We've got to complete the transcription, but the audio version and the transcript will be posted to the CDIAC website under our education link. And with that, if we don't have any other follow-on questions, and at this point I'm getting an indication we don't. So Louis, thank you very much for leading this discussion, and we look forward to Part 2, again, August 20th at 2 o'clock. You will have to register separately, so if you participated today, you'll have to go on and register for Part 2. With that, we'll close out the program. Thank you all for your participation, and Louis, again, thanks for leading the discussion today.
Thank you.